Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by NYFI-linked, helping you deliver through volatility.
Hello, everyone. Good morning, good afternoon, good evening. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
Doing excellent. Once again from my home office here in Denmark.
You're looking fancy with the blazer over the t-shirt look, a classic for Lars.
There we go.
So Lars, talk us through what we're at with the Asia to US West Coast rates.
Yeah, Asia to US West Coast rates continue to increase. I wouldn't say they were massive up, but we're up at around $2,300 or so per 40 footer, so a steady increase. When we're looking into some of the futures prices as well, we are looking at a further increase of a few $100s in the months ahead. But overall, with the risk of sounding slightly callous, nothing really exciting. I'm sure if you're a shipper and you suddenly are faced with hundreds of dollars of increases, it's not a nice situation. But given the geopolitical turmoil, this is actually a very, very calm development. I know we're going to talk more about Hormuz later on, but the increases that we are seeing here mainly reflects the increases coming from an escalation in bunker fuel prices. And that's about it.
Yeah, definitely surprising. I think if you would have made guesses back in late February when everything broke out, you probably would have assumed skyrocketing rates. So I guess it's good if you're on the paying end of these rates that it's not jumping as high.
And back when the crisis broke out, the carriers were using the same playbook they did for the Red Sea crisis, the one they learned during the pandemic as well. If there is a major disruptive effect, you better go out rapidly and take action. Because if you don't, you're going to lose an enormous amount of upside opportunity. And that basically is the playbook they also deployed here. What we can now see here 6.5 weeks into the conflict, sure, there are increases, obviously massive increases into the Gulf. But for the rest of the world, most of the increases that are coming through now are reflecting actual cost increases, especially from fuel.
Yeah. Let's take a look at the Asia North Europe trade lane as well.
Yeah, Asia North Europe, the increase was now fairly marginal. And again, it's one of those where what would happen, especially given we saw what happened with the Red Sea, but the impact here of also the Hormuz is very, very benign. We're now at around 2,300. We're still looking at, on the futures market, a potential apex all the way up at 2,850 once we get into the height of the peak season. So another $500 up compared to where we are. And this is one where there was also interesting news coming out here just before the weekend, because as I hope a lot of our listeners have noticed, the futures contracts based on the NYFI index went live on the Intercontinental Exchange last week. And we already have a confirmation of at least one deal that has been made, in this case, a futures contract on the Asia North Europe market for the month of May at a level of 26.50 per 40 foot. So that's basically a $300 premium compared to where the market is roughly now. And just to be clear, what does that mean? Well, it basically means that there's a buyer and the seller in the market that took a look at where's the market now, what is the risks in terms of rates escalating dramatically or rates dropping, and both parties from a risk perspective apparently found that a rate level roughly $300 above where we are now in May sounded like a reasonable balance, looking at all the risks involved.
Interesting. Yeah, super cool to see the first deal signed.
Yes.
And we'll probably have many more to report on, but the first one is always the most exciting, of course. So let's switch gears a little bit. Let's talk about what's going on with Iran.
Yeah, certainly. If we look back over the last week, what happened last week was there was a ceasefire announced. And when that was announced, it was a matter of, at least from a U.S. perspective, said, well, now there's a ceasefire, so the Hormuz is going to be normal. That was not how the Iranians saw it. So to be quite blunt, the ceasefire changed absolutely nothing. It did. I mean, Iran and the U.S. stopped bombing each other, but that's it. In terms of shipping through the Strait of Hormuz, absolutely nothing changed. We continue to see a very small trickle, say 5 to 10 ships a day come through the Strait of Hormuz, versus a normality that was 130, 140 before the war. So from that perspective, absolutely nothing changed. The Iranians are saying, fine, they want to have a toll paid. This is also where things get slightly murky. There are some vessels that have paid. There are some that haven't. It is not always clear exactly who do you even have to talk to in Iran to go through. For shipping lines, it's also another consideration. It's highly likely if you as a shipping line actually do pay the Iranian Revolutionary Guard to go through, you will be in violation of the US OFAC sanctions, which could risk either you getting fined or you getting US sanctions on yourself as well. So most shipping lines are just hanging back. They're actually not going through at all. That then led up to a situation here over the weekend where apparently the US president got a little bit impatient that nothing was moving. So he now announced a US blockade against all vessels. Initially yesterday, Mr. Trump announced that the blockade would be on all ships that move through the Strait of Hormuz. US Central Command then came out with a slightly different message here today, and that's what actually came into effect. We are recording here 40 minutes after the blockade came into effect. And now the blockade is supposed to be on vessels that go to and from Iranian ports. What will that mean for shipping? Well, first of all, for container shipping, not very much. For shipping overall, not very much. Why wouldn't it be very much? Because the vast majority of the ships that go through were already not going through. Sure, there will be even less oil coming out now from the Persian Gulf, but compared to the dent we put in the shipping already, this is a marginal impact. That's not what I'm concerned about. I'm concerned about something else that hopefully will then not evolve, because during today, a few hours before the blockade went into effect, there was an announcement from the Iranians that if the blockade is effectuated, they could potentially start bombing port facilities, not only in the Persian Gulf, but also in the Gulf of Oman. And for container shipping, this would be a significant problem, because now that we can't move container ships through the Strait of Hormuz, there are two main gateways to take cargo to and from the Gulf. It's overland from either the Red Sea or from the ports in the Gulf of Oman. And the ports in the Gulf of Oman, that would be Salalah, it would be Fujairah, it would be Duqm, it would be Sohar, it would be Muscat. Those are potentially the ones. So if the Iranians actually follow through on that threat, this would suddenly wipe out one of the only two key overland gateways to actually service the Persian Gulf. So what's going to transpire the next 24 hours will be extremely interesting to see, to use hopefully a somewhat neutral word.
Yeah. Okay, so a lot's happened. A little bit has happened that has very little impact, but then there's maybe big consequences that could be coming. So,
Yes.
Yeah, definitely a lot to keep an eye on, and we'll report on that as the week progresses on our episode next Monday. Let's talk a little bit about oil prices. You mentioned at the start of the episode, a lot of the rates seem to just really be reflecting changes in oil prices or bunker fuel. Where's that at right now? Where is it potentially headed?
Yes, and I think this is where it's good maybe to put things into context in extremely round numbers. If you look at the standard low sulfur fuel, it was around, say, $600 a ton prior to the war. Ever since the war broke out, sure, it's been volatile, fluctuating, but roughly hovering around $1,000. And if I only mention those two numbers, that sounds like an extreme increase. And of course, it is from 600 to 1,000. But we should keep in mind, if we go back to 2020, when we had the low sulfur rules come into place, it was actually not so much driven by the pandemic. We had bunker fuel prices that were even higher, sustained for a few months. And that didn't in itself wreck the market. If we go further back, we cannot look at low sulfur fuel prices because that was prior to the IMO rules of 2020. But if you look at normal bunker fuel prices now are very, very elevated, say $700-800 a ton. But we were at the same level back for a couple of years in 2013 to 2015. And yes, that of course also translated into cost, but it also tells us that even though the price is now high compared to what we've been used to for a few years, this is not some sort of unprecedented disaster. We have been here before, and the supply chains worked just fine in 2013 to 2015.
And did we see rates dramatically increase during that time period, or very little increases?
No, what we did see back then was actually, and that's somewhat reflected in what we also talked about before with the carriers suddenly increasing fuel surcharges now. Carriers also rapidly changed fuel surcharges back then in order to try to, I wouldn't say capitalize, but at least try to mitigate the rapid increases in fuel price. Back then, a lot of the fuel surcharges were adjusted quarterly, just as they are now. But as fuel prices surged back then, quite a few carriers suddenly went to monthly adjustments in order to capture the prices as they went up. So somewhat the same play out there as we're seeing now.
Yeah, interesting. Could you tell me a little bit about where demand is at? Are we seeing any big fundamental changes there?
No, you can say we're basically seeing the same development that we've seen for a while. Now, the advantage is we got new demand data from Container Trade Statistics here just before the weekend. So that means we now have both January and February. And because of the shifting nature of Chinese New Year, when you do the beginning of the year, you should always look at January and February in combination to avoid some of these effects of shifting New Year.
Okay.
And the world as such saw 7.5% demand increase. This is very, very strong growth. Not just if you look at the last few years, but I would say if you look at the decade between the financial crisis in 2009 and up until the pandemic in 2020, 7.5% demand growth is very strong indeed. That's good for the overall market. But as we've been talking about many times on the podcast, it's bifurcated. This is North America pulling everything down, the rest of the world pulling everything up. If we look at North America, we actually see North American imports down 2.1%, whereas the rest of the world outside of all North American cargo is up as much as 10.7%.
And are you
Very
comparing
much
this
pulling up.
from January, February of 2025?
January, February, yeah, exactly. It's year on year. So Jan, Feb this year compared to last year.
Gotcha.
The only region that really is also showing decline, that's European exports. It went down more than 3% year on year, which also continues the trend we have now seen for a couple of years. European exports are basically in free fall and have been for a sustainable amount of time, whereas the free fall we see in North American volumes are very clearly time-stamped to begin right the moment the trade war kicked off. So, yes, sure, there are some negative spots, but global growth is strong, and what is phenomenally strong, and that's also a continuation of a trend, is Africa. Africa, by far here in the beginning of the year, shows the strongest growth in both imports and exports. Imports are up more than 22% year on year. Exports are up almost 14% year on year. So Africa continues to really pull strongly. Keep in mind, overall volumes are still relatively low, but they won't remain low forever.
Gotcha. Okay, so the Africa import-export number could be a reflection of a low base number comparison, so the growth looks really high, but also we expect this to continue into the future.
It has been going on for quite a while, and we should expect this to also continue for, I was about to say, years to come.
And I wanted to ask you a little bit about the Europe exports being down, and you said this is a pattern that's been continuing for a while now. As someone that lives over in Copenhagen, you might probably have a different perspective on things, but I wanted to just ask like where that might be coming from or some reasons behind it.
Yeah, I think, again, making things slightly black and white, it seems that we are not really producing a lot in Europe that anybody wants to buy. It's as simple as that. To some degree, it's no different than North America. It's just European exports have been even more anemic than North American exports recently.
Okay, gotcha. And then do we have any information about the average rates from CTS?
Yeah, I mean, they have this global rate index, and as a global index, from my perspective, it's the best because it includes all trade lanes. It includes both spot and contract. Not measured in dollars, it's an index, of course. And what we saw here, again, looking at Jan Feb compared to last year, rates are down 15%. And of course, that is up until just before the Hormuz crisis. We might see some strengthening here because of all of the sudden emergency fuel surcharges once we get to March and April. But the beginning of the year, down around 15%.
And does the CTS rates, do they include, is it only containerized freight?
They contain basically all, you can say, the ocean-borne charges. So that would be your basic freight rate, it would be your bunker surcharges, anything really related to your cargo moving from point A to point B. But they don't include terminal handling or inland movements.
All right, gotcha. Cool. And then OOCL released their Q1 earnings. We learned from their report.
Yes, OOCL is always the first ones to come out with their quarterly results. This time was no exception. So if we look at least the first major carrier to come out there, is volumes are up almost 2% year on year. Now, for anybody that listened to me 10 minutes ago, you will find that's pretty low, because CTS data so far says 7.5% up. Now, mind you, CTS doesn't include March, but it still shows OOCL has clearly given up some market share in the beginning of the year. No doubt about that one. If we look a little bit deeper into the trade lanes they break it into, we see quite also a bifurcation with OOCL. Their Asia-Europe volumes were up almost 12%, whereas their Pacific volumes were down almost 6%. So it's Asia-Europe that's helping them, but Pacific, where they are heavily exposed, is what's dragging their overall volume performance down. Okay, so they're losing a little bit of market share. How did they then do on rates? And it's what we relatively often tend to see, that if a carrier underperforms on volume versus market, then usually they're doing better on rates. That's also the case here. Because the CTS global rate was down, as I mentioned, almost 15%, but OOCL's rates were only down around 9%. And if we look a bit over the trade lanes, rates for OOCL was down almost 15% on Asia, Europe, 12% on Pacific. But there are other trades, Atlantic, and they're also large and intra-Asia, only down 2 to 3%. So the OO performance here shows us what we tend to see quite often. If you underperform on volume, you typically overperform on rates, or vice versa. It's always more interesting, what I would also look for as the other carriers come with their Q1 results, is to see, does anybody break this pattern? If you underperform on both volume and rate, that is clearly a sign of problems. Right. If you overperform on both, that's clearly a sign of strength.
Yeah, I agree with you. It'll be interesting to see what the other carriers are showing. All right, Lars, anything else you want to add for today's episode before we log off?
No, I think that basically covers all of it for those that listen to it very, very early on. Keep your eyes peeled on what happens with the now U.S. embargo that went into effect 51 minutes ago as well. Hopefully this doesn't lead to anything. The problem is it sets the tone for a potential escalation of the conflict as well. We'll have to see how this play out in the coming hours and days. Yes,
we will definitely be reporting on updates next week. Thank you all for tuning in to our episode. If you haven't already subscribed, we are on Apple Music, Spotify, YouTube, you name it. And we'll be back next Monday for a new episode. Thanks for listening, y'all. Have a good one.
Thanks for listening to the Supply Chain Secrets Podcast, presented by NYFI-linked. Be sure to subscribe on your favorite podcast app.